With the United States stock market absolutely tanking today, right now the S&P is down about 1.4% after a key inflation report was released this morning. We have a lot to talk about as it relates to the broad market here and what are the highest probability things that are going to happen next so that you guys, the viewer, can position yourselves in the most responsible way going forward here. We have a lot to talk about, guys. We're going to be talking about the broad charts of the S&P, breaking down this inflation report. We're going to be talking about growth expectations, the tariffs that are coming out, consumer sentiment. We have a lot to cover in this video here, guys. So before we get into all of that information, if you guys do enjoy the information and analysis I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. Let's see if we can get this video to 500 likes. That would be absolutely awesome. And again, make sure you guys are subscribed and turn on notifications so you never miss another video like this. But without further ado, let's get into it. I don't want to waste any of your guys' time here because we have a lot to talk about, and this market is moving very aggressively. So, moving over here and just taking a look at the broad chart of the S&P 500 ETF, the SPY right now, we are blasting down below a couple of very, very key levels here. A lot of people have been labeling this little move here up that we have seen in the overall structure in the S&P 500 as a bit of a bear flag. Now, for me personally, until we really crack down through this 588 level here, I wouldn't really get all that worried, and we're going to go over some of those reasons why throughout the remainder of this video here. We can also kind of look at what's happened in the past when these type of technical setups have formed in the market here, really over the last 2 years. A lot of these bear flags that we have seen, these technical setups on the chart with significant moves down and slow and steady kind of choppy moves back to the upside there, have been bought, and we have seen the market make new highs after that. Now, I'm not saying at all here that we are looking for the market to make new highs, but I think a lot of this doom and gloom might be a little bit overdone. And again, that's what we're going to start covering here. So when we take a look at this inflation report, the PCE, remember, this is the Fed's preferred metric of inflation. It's not CPI, it's not PPI, it's PCE. So when you hear the Fed talk about, or Jerome Powell talk about their dual mandate, maximum employment and price stability with their long run inflation target at 2%, they're referring to PCE here. So the U.S. February PCE price index rises 0.3% month over month. The estimated reading there was 0.3, so right at expectations. U.S. February PCE price index rises 2.5% year over year, and the estimate was 2.5. The only thing that was a little bit higher than expected here was core PCE there. So 0.4% month over month, and the estimate was 0.3. Year over year, we saw a 2.8% year over year increase versus the estimate of 2.7. And guys, when we think about core PCE versus headline PCE, core PCE is leaving out the volatile food and energy items. And as you guys may have noticed, egg prices are down. A lot of the other elements in that food category have significantly decreased as well. Oil has been on a little bit of a downtrend and has recently kind of picked back to the upside there. So again, if you take those out of that headline number, again, the core PCE numbers can be a bit higher. Now, in addition to this today, again, a lot of people are citing tariffs for some of the main reasons why the market has been selling off so aggressively. And while tariffs are one of the main factors that is driving market uncertainty, it's leaving out, if you just focus in on tariffs, it's leaving out really the big picture here, and that is the growth story and the potential for this growth slowdown. Remember, this new administration is looking to cut significant amounts of government spending. They are not only just not hiring additional government employees, but they're also firing government employees as well. And for those of you guys that don't know, about 25% to 35% of GDP every single year is a direct result of government spending. So if you lower government spending, growth can start to slow down. And that is exactly what we are starting to see in these GDP expectations from the Atlanta Fed. Remember, back in late February, early March, we saw this dive off an absolute cliff here for the estimates for the first quarter of GDP growth. We went from about a little bit over 2% all the way into the negative 2.8, 2.9% territory here. And right now, we just got released the new number on March 28th, 2025, the latest estimate for the first quarter of United States GDP is negative 2.8%. So if you expect growth to slow down, obviously that is going to limit earnings across the board. It's going to make it a lot more difficult for these CEOs to make decisions moving forward. And again, you might see this little bit of a flight to safety move that we are seeing in today's market. But there is a little bit of a silver lining in this. And again, make sure you guys are paying attention here because this gets very, very little bit involved, but it's very important to understanding the big picture of the broad market here. So we've talked about growth. We've talked a little bit about inflation here. Now, I also want to bring up some of these comments on the consumer side before we start getting into some of these additional comments on these new auto tariffs and what we have to look for going into this April 2nd trade deadline. So when we look at consumer sentiment over here, again, if consumer sentiment is very high, well, then consumers are more likely to go out and spend money in the economy, and it can easily stimulate a little bit of growth there. It can be a little inflationary, but again, it can easily stimulate some growth in the economy, but that is not what we are seeing here. The survey came in, again, the estimate was about 57.9 for consumer sentiment, and the actual came in at 57. Now, one of the most important things that we are seeing here that I think a lot of people are failing to really realize has to do with inflation expectations. I've brought up the chart to you guys many times about the 1-year inflation expectations survey broken down by political party. The Republicans think inflation is going to be like 0.1% in 2025. Wrong. You also have the Democrats saying that it's going to be in the 5 to 6% range. Also wrong. And the independents are kind of somewhere in the middle there. And this is driving these 1-year inflation expectations much higher. Right now, the prevailing expectation right now is that inflation moves to 5% in 2025. Now, this creates a very interesting dynamic between consumer purchasing decisions and also the Fed's decisions in whether or not they're going to be decreasing interest rates or not. And I want you guys to think about it like this. If you think that the prices of goods and services are going to be much higher in the future than they are right now, well, then you would go out right now and start purchasing things in the present. So if that's what you were to expect to happen, well, then we then have to go and confirm that with data. Okay, so let's actually see if that is occurring. Well, when we move over here, February personal income was up 0.8% month over month, with the estimate being at 0.4%. So incomes were up. Check. Personal spending rises 0.4% with the estimate at 0.5. So spending was a little bit lower, and real personal spending was up 0.1% month over month. So that's accounting for inflation, and the estimate was 0.3. So spending was a little bit lower. So when you think about a lot of these different situation, guys, that are happening in the market all the time, and people coming out and showcasing their opinions, this is something that I say all of the time. Unless somebody has skin in the game and they're actually putting risk on when they come out and make certain projections or expectations, I really don't care what they have to say, because what I want to see is actual hard data. And that is what we are starting to see here. And when we move over and take a look at savings rates as well, more February personal income and spending, personal savings rate is 4.6% versus 4.3% in January. So people are making a little bit more money, they're spending less, and they are saving more. So one of the main reasons, guys, why the market is selling off so aggressively right now is that we have slowing growth expectations. We know that unemployment is ticking up a little bit, and the prevailing expectation in the market right now is that inflation really starts to ramp to the upside, but the actual behaviors from the consumers aren't really saying that they think that is going to happen. It's just showing up in these surveys. And then when we think about the effects of tariffs, which again is one of the main reasons why you are seeing this big discrepancy in inflation expectations through this year, well, we also have to think about the fact that we do not know what the effects of these tariffs are actually going to be. The textbook will tell us that tariffs are a little bit inflationary there, but if you just listen to what Jerome Powell said at the last FOMC meeting, he said that even if there is going to be a little bit of inflation due to these tariffs coming into effect here, he believes that it is going to be transitory, which leads us into something very interesting here as well. We have some more comments on these new auto tariffs that I think we should also talk about, because again, this one in particular is pretty interesting because it seems like a lose-lose across the board. So when you think about, guys, this new administration, specifically Donald Trump, coming out and slapping tariffs on a lot of these other countries, Everybody and their mother knows what happened last time that we had trade war, tariff war 2.0. A lot of this was really just used as a bargaining chip to get what Donald Trump wanted. Now, this time around, if everybody knows that, it weakens the power of anything that he's going to say. But when you have this situation here where you really come out and start sticking to your guns, it might be possible that that bargaining chip power comes back, and eventually, like we saw from the EU today, they will come to the table and start to negotiate. But reading some of these comments here from Dan Ives about these auto tariffs provides a little bit of a better picture into the actual effects of what these tariffs would do. Over the last 24 hours, we have spoken to many in the auto industry from around the US, Europe, and Asia, and the conclusion is this tariff announcement in its current form would send the auto industry into pure chaos and raise the average price of cars between $5,000 on the low end to $10,000 to $15,000 on the high end. Ferrari already said after April 1st it will raise prices on certain models in response to the new tariff. Every automaker in the world will have to raise prices in some form. Selling into the US and the supply chain logistics of this tariff announcement heard around the world is hard to put our arms around at this moment. Even US automakers that produce cars in the US have 40 to 50% of auto parts that come from abroad. A US car with all US parts made in the US is a fictional tale, not even possible today. In our view, it would take 3 years to move 10% of the auto supply chain to the US and cost hundreds of billions of dollars with much complexity and disruption. The concept of this auto tariff, in our view, would be the backbreaker and Armageddon for the auto industry globally and throws the supply chain into pure panic mode. We believe this adds up to $100 billion of cost annually to the auto industry and will essentially get passed directly onto the consumer and clearly erode demand on day one of tariffs. Now, I would say here, again, after what's happened kind of over the last couple of times that we have seen these very aggressive tariffs come out, that there is going to be some sort of deal that is reached before the deadline. We already saw the EU this morning come out and they said that they were going to kind of issue some concessions and come to the table and make some sort of deal. But again, these types of potential inflation coming into the market here is why the market is freaking out so much. But again, what we have to realize here is that we don't actually know what the full effects of these tariffs are actually going to be. And what the market is really failing to realize here is what actually happens if there isn't an increased amount of inflation due to these tariffs coming into effect here. And that is the most interesting part of this situation that I think people are really not focusing in on, is if we do not see inflation starting to move back to the upside, what are we left with? Well, we still have the plans for decreased government spending. We still have unemployment starting to tick to the upside. And if inflation remains at these relatively low levels, you could easily see that Trump put some deregulation coming in, Trump coming in, and really the Trump administration coming in and backstopping the economy here with some deregulation efforts, specifically in the banking sector, which again, Scott Bessent, the U.S. Treasury Secretary, has said that they have plans to do. Or two, the more interesting side, is that the Federal Reserve could come out this year and cut rates by a lot more than what the market is currently expecting. And that could stimulate a lot of growth across the board, because if you're going to lose a lot of that almost stimulative effect of the United States government propping up the economy over the last couple of administrations here, again, including the last Trump administration, I'm not trying to make this political here at all, well, you have to make up that growth somehow. Now, how can we do it? Well, we can have a lot of new fiscal policy coming out on the actual United States government side, or we could have some adjustments to monetary policy. Now, what Jerome Powell and the Fed have already stated that they are doing at this current time is they are in wait and see mode. And that's what I think a lot of investors should be in this market right now. We are seeing a lot of volatility, not only in markets, but also from the news cycle where these new tariffs are announced. People think inflation is going to ramp back up, growth is slowing down. But again, the main thing that you guys have to realize is that a lot of these new plans and these effects of these new plans are not going to actually take effect or actually show any, let's say, results or negative effects for a decent period of time, a couple of quarters. So I would say that a lot of the short-term volatility in markets right now is very, very overdone. Now, the last point that I want to make to you guys on the inflation side kind of goes back to what we were talking about very briefly earlier in this video, where we need to see if large money players and institutions are actually going to put their money where their mouth is and listen to some of these survey expectations. And we have a really good gauge of that by looking at 10-year treasury yields. So what we're looking at right now is the yield of the 10-year US government bond. Now, if all investors in the actual market right now fully believed that inflation was going to start roaring to the upside, what then happens to the value of the United States dollar when that happens? Well, it decreases. So when you're looking for fixed income, you have to be very, very careful when you're locking in these interest rates for an extended period of time, because your real rate of interest in return will decrease if the value of the United States dollar decreases as well. So if the broad market was really expecting inflation to roar to the upside in 2025 and go up all the way to 5%, well, the exact opposite of this move that we're seeing today in 10-year treasury yields would be happening. Markets would be selling off bonds like crazy and not buying them up like you see it happening here. Now, again, you could also, again, for those of you guys that don't know, there's an inverse relationship between bond prices and bond yields. So when you see bond yields go down like this, it means that investors in general are buying up bonds, providing more supply than demand, and bidding up bond prices here. So again, just want to make that clear. Now, you could also make the argument that this is just a flight to safety. People are rotating out of equities and into the bond market. Now, while that is true, you can say that the risk of inflation actually moving up this year to 5% is a very, very daunting event. If that were to happen, that would be very, very, very bad for the broad economy, because we would be in a potential position of stagflation, which is a central banker's worst nightmare. And if that were the case, you would most likely see all of that selling pressure from those inflation fears outweigh any buying pressure coming into the U.S. Treasury market there based on that flight to safety move. So I think for a lot of you guys here that are long-term investors, remember, there is going to be a lot of volatility in markets in the short term. And if you can understand the big picture of what's actually happening, well, it gives you a lot better of an understanding of, okay, here's what's likely to happen with markets next. How can we position ourselves for the future? And again, kind of really tone down the emotional effect on yourself due to all of this volatility that we're seeing in the short term here. So to wrap this up in a little bow for you guys, to wrap up this video here, it does appear that the markets in general are witnessing an overreaction to a lot of the short-term data coming out here. We are seeing PCE come in right basically at what the markets were expecting. But when you take out food and energy, again, those volatile elements that actually have been trending lower, you did see a little bit of a higher than expected reading there. But again, understanding everything that's happening in the market, all of the data points, again, is going to make it a lot easier for you as a long-term investor to be able to ride out a lot of this short-term volatility and really lessen the emotional effects of a lot of this craziness happening in the market in the short term. Because again, when the markets are overreacting in the short term here, that can be a good tactical buying opportunity for you guys that are long-term investors. Now, again, if you already have a dollar cost averaging system in place, you don't really have to do anything. And again, for me right now, this is really not the time where I'm going to be looking to start buying in any size, but more on that in another video. So guys, that is going to wrap up this one here. If you guys did enjoy the information and analysis I provided for you guys in this one, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you're notified every time these videos go live. But until next time, guys, I will see you. Peace.